Hey traders, welcome back to our channel. In today's video, we're diving deep into one of the most powerful concepts in smart money trading, fair value gaps. These hidden gems can be game changers in your trading strategy. Stick around as we uncover the secrets to mastering fair value gaps and how you can leverage them for more precise entries and exits. Let's get started. What exactly is a fair value gap? A fair value gap is a price range where there is an imbalance between buyers and sellers, typically identified when there is a significant price movement without a corresponding retracement. This creates a gap on the chart, indicating an area where price action is likely to revisit, providing traders with potential opportunities for precise entries and exits. In a bullish market, a fair value gap is identified between the wick of the first candle and the wick of the third candle in a three-candle sequence. This gap creates an imbalance in the market, indicating that the price is likely to pull back to refill this gap before continuing its upward movement. By correctly pinpointing these gaps, you can capitalize on long positions as the market pulls back to fill the gap and then pushes higher. Similarly, in a bearish market, a fair value gap is found between the wicks of the first candle and the third candle in a three-candle sequence. This gap also creates an imbalance, attracting the price to pull back and refill it before continuing its downward movement. By identifying these gaps, you can capitalize on short positions as the price pulls back to fill the gap and then resumes its decline. But here's the challenge: when you look at your charts, you'll often see fair value gaps everywhere. This can be overwhelming and confusing for many traders, making it difficult to determine which fair value gaps are valid and which ones are not. In many cases, you might correctly identify a fair value gap and anticipate a short position when the price pulls back to fill the gap. However, instead of respecting the setup, the price breaks above the gap, taking you out of the trade and leaving you wondering what went wrong. The truth is, trading fair value gaps is not as easy as most traders say. Only professional traders can trade them with ease. In my trading experience and knowledge, I have come up with 6 essential rules you need to follow to master the concept of fair value gaps. These rules will help you filter out the noise, validate the significant gaps, and improve your trading success rate. The first rule to follow is the three-candle sequence. This rule helps you identify valid fair value gap setups. In a bullish market, the gap must be between 3 consecutive bullish candles. Similarly, in a bearish market, the gap should be between 3 consecutive bearish candles. If you come across a situation where there is a gap, but one of the candles is in the opposite direction, just like in this example, where there's a bearish candle between bullish candles, this does not fit the 3-candle sequence. Such setups are invalid, and you should avoid them to ensure your trades are based on reliable patterns. In this price chart example, we have a gap between this 3 bullish candle sequence. This means that this fair value gap is valid and eligible for buying. However, if there were a bearish candle between the 3 bullish candles, then this gap would have been invalid. We see another gap between a 3 bullish candle sequence. Again, this fair value gap is valid and eligible for buying. If there had been a bearish candle between the 3 bullish candles, then this gap would have been invalid. The second rule states that your fair value gap must remain unmitigated for it to be valid. This is crucial to avoid false signals. In this example, we have a gap between the 3-candle sequence. When the price pulls back to fill the gap, it gives us the opportunity to go long as the price moves upward. However, fair value gaps are a one-time use. Once a gap is filled, it becomes invalid. Even if the price pulls back to retest the gap, you should refrain from looking for further buying opportunities there. Entering on a used fair value gap often leads to losses. In this price chart example, we have a gap between a 3-candle sequence. As you wait for the price to pull back and fill the gap, the very next candle retests your gap with a wick. For this reason alone, this fair value gap is now invalid. Even if the price pulls back and retests this fair value gap, you should not look for any further selling opportunities because this gap is already used. Entering on this used fair value gap can lead to losses. The next rule is that your fair value gap must lead to a break of structure. Many traders take this rule for granted when trading fair value gaps, but it ensures that the directional bias of the market remains intact for further trading opportunities in that direction. In this example, we have a gap within a 3-candle sequence. This gap led the market to break above the previous high. Since this rule is met, it means the setup is valid. You can then wait for the price to pull back and fill the gap, allowing you to execute your buy orders with confidence that the market will likely respect your setup. In this price chart example, we have a fair value gap between a 3-candle sequence. This gap led to a break of the previous high, rendering this setup valid and eligible for trading. However, we encounter a slight problem: there is another gap on top of the previous one. This situation often confuses traders because with two gaps on top of each other, which one is more eligible to trade from? To address this confusion, we need to look at rule number 4. Rule number 4 is about premium and discount. If you are not new to this channel, you've probably heard this concept multiple times now, which shows how significant it can be to your trading game. Using this example, you should always ensure that in an uptrend, your fair value gap is within the discount pricing range for it to be eligible for buying. The discount pricing range is where most traders will look for buying opportunities, anticipating the price to continue pushing to the upside. To address this question, we will consider the gap that is within the discounted price range. If both gaps are within the discount price range, the one closer to the equilibrium is less eligible to buy from, while the one further away from the equilibrium is more eligible. So, in this confusing scenario, we can conclude that this gap is the one we should buy from. Wait for the market to pull back and fill this gap, then execute your buy orders. The price will most likely respect your setup. The next rule is called the order block and fair value gap entry. This occurs when you have a valid fair value gap, and below that gap, there's an extreme order block. The problem here is that this order block will most likely influence price movements. Instead of respecting our fair value gap, the price might drop to retest the extreme order block. In cases like this, trading the fair value gap exposes you to the risk of losing trades. One might suggest placing the stop loss below the order block instead of below the gap to stay safe even if the price doesn't respect the gap. However, this approach risks a larger amount of capital and significantly reduces your risk to reward ratio. The best strategy here is to change our entry point, enter exactly at the first wick of the gap and place your stop loss below the order block. This way, we risk less while maintaining a high risk to reward ratio. It's important to note that sometimes you will miss trades because the price might respect the gap and push upward without reaching your entry point. However, it's better to miss a trade than to lose capital. So, always execute your buy orders at the first wick of the gap when you have an extreme order block below it. In this price chart example, we have a valid fair value gap. However, below the gap, we have an extreme order block. We know that this order block can influence price movements. Entering at the second wick of the gap means risking more on our trades with a reduced risk to reward ratio. The best strategy is to enter on the first wick of the gap, which minimizes our risk per trade while increasing our risk to reward ratio. Now, we wait and hope that the price will drop and reach our entry point so that we do not miss the trade. Luckily, in this case, the price dropped and reached our entry point. We then execute our buy orders, and the price will most likely push up and reach our target. This is a very tricky situation, but with what I've shown you, I hope you can easily maneuver out of such situations with ease. Here's another price chart example. We have a fair value gap within a 3-candle sequence which is valid. Above this gap, we have an order block. We know that this order block will most likely influence price movements, so to be safe, we need to place our stop loss above this order block. Entering on the second wick of the gap means risking a large amount of capital per trade with a reduced risk to reward ratio. Instead, we should execute our sell orders on the first wick of the gap. This way, we minimize the risk we are exposed to while increasing our risk to reward ratio. Now, we wait and hope that the price will pull back to reach our entry point. Once that happens, we can execute our sell orders, and the price will most likely drop and reach our target. The last rule is the 50% fair value gap entry. Sometimes in the market, you may come across a perfect fair value gap entry. However, the gap might be too large for you to enter your trades with minimal risk. If you execute your buy orders at the start of the gap, you would be risking a large amount of capital with a reduced risk to reward ratio. To solve this problem, we use the 50% fair value gap entry. Instead of entering at the start of the gap, we enter at the 50% mark of our fair value gap. This way, we minimize the risk we are taking per trade while maximizing our risk to reward ratio. However, it is important to note that you will miss some trades because the price might retest the start of the fair value gap and then reverse back to its original direction. But it's always better to miss a trade than to lose capital. In this price chart example, we have a gap presenting possible selling opportunities. However, this gap is quite large. Entering your trades from such a large gap would mean taking a significant risk per trade with a reduced risk to reward ratio. To solve this problem, we use the 50% fair value gap entry. Instead of entering at the start of the gap, we enter at the 50% mark of the fair value gap. This way, we reduce the risk per trade while maximizing potential profits. All you need to do is wait for the price to pull back and reach your entry point. From there, execute your sell orders, and the price will most likely drop and hit your target. Here's another example. We have a gap for possible buying opportunities. Depending on how much capital you have, this risk might be too large for some trades. If you execute your trade at the start of the gap, you will be subjected to a significant risk, resulting in a well-reduced risk-to-reward ratio. To solve this issue, you should use the 50% fair value gap entry. This way, you reduce the risk while maximizing the risk-to-reward ratio. What you need to do now is wait for the price to pull back and reach your entry point. From there, execute your buy orders, and the price will most likely reach your target. In summary, understanding and applying these rules can significantly improve your trading performance. By using the 3-candle sequence, ensuring your fair value gaps remain unmitigated, confirming a break of structure, leveraging premium and discount pricing, and strategically managing order blocks and large gaps, you can enhance your risk management and increase your success rate. Remember, it's always better to miss a trade than to lose capital. Thanks for watching, and if you found this video helpful, don't forget to like, share, and subscribe for more trading tips and strategies. Happy trading!